Hello, everyone. We're just going to give people a couple seconds to get into the Zoom call today. There's quite a few attendees, so bear with us. We'll be with you in a minute. I love it. People are already asking questions. So good. All right. Well, while the participants continue to join the call, I'm going to kick things off. Welcome to Boutique Week. I'm Stacy Havener, founder and CEO of Havener Capital Partners, and your host for Boutique Week. And we're closing day 2 of the call series with 2 gentlemen that need no introduction, but I'm going to introduce them anyway. Lee Goehring and Adam Rozencwajg, co-founders of Goehring and Rozencwajg, affectionately known as G&R. Rock and roll has Guns and Roses. We have Lee and Adam. Am I right? Legendary minds in the commodities and natural resources space, and talented portfolio managers as well. And I say that well aware of the dynamics that are happening in this asset class right now. We're playing the long game, team, and there's no one better than Lee and Adam to be our guides in this space. So Lee, Adam, thanks for being with us. Couple housekeeping items. What we'll cover on the call, we're going to do a very quick firm update. Adam's going to take us through current positioning and performance. We'll spend the bulk of the time on market outlook. And you guys have been amazing with your questions. We've had a ton of pre-submitted questions. Please continue to ask your questions in that Q&A pane in your Zoom control panel there. We'll do our best to get through as many as we can. If we don't get to your question, we will absolutely circle back and make sure that your question is answered after the call. I'm sure many of you already follow G&R on Twitter and LinkedIn, but if you aren't, please join us on the social media platforms, and you can sign up for their blog on their website if you haven't done that yet. Please feel free to join us there too. So I'm going to do just a couple firm updates here, really just more around content. I mean, Adam and Lee are amazing at not only putting together this epic research, but with sharing that research with all of us. So I wanted to mention a few places where you can get more G&R, more of their thought leadership. Adam did a keynote in August in Zurich called The 100-Year Extreme. You can read that in their last letter, or you can watch that presentation on YouTube. In addition, and some of you may have already seen this, but there's a great interview between Jim Grant and Lee Goehring on Real Vision. They actually re-released that in October, so check that out. And then the podcast, Super Investors and the Art of Worldly Wisdom with Jesse Felder, that was also done in October, so feel free to check that one out as well. So with that, I'm going to pass it over to Adam for positioning and performance update. Adam.
Great, thanks, Stacy, and thank you everyone for zooming in today. It looks like there's people calling in from all over. So good morning to those in Asia, good afternoon and evening to those in Europe, and good afternoon to everyone in the US. I'll start with just how we're positioned today, and obviously that's, I think, pretty consistent with our research that we put out in our last quarterly letter, so there's probably not a huge number of surprises there. But I'll also talk about some of the changes that we've made over the year and where we are today. And then from a performance perspective, as Stacy mentioned, it's been obviously a volatile and challenging year, but at the same time, there's some things I think to be happy and enthusiastic about. So from a holdings perspective, our long-term followers will know that the big change we made this year was to increase our energy exposure earlier this year. And that was really in response to market action on the oil and gas sector of the portfolio, mostly on the oil sector. When oil prices went down to negative $37 a barrel, we saw the energy weighting in the portfolio get as low as about 20% of the portfolio. We wanted it closer to 40%. That's where we felt comfortable given our thematic long-term view. And so we made that change back in April and May of this year. That's been the big material move that we've made so far this year. And other than that, it's really been sort of incremental changes to small positions here and there. As of September 30th, the quarter end, we were 42% weighting to oil and gas, and that breaks down about 22% oil-related E&P stocks, 14% gas stocks, natural gas stocks, and 6% in oil services and offshore drilling. Copper is our biggest theme outside of the energy patch, and that's at 20% of the portfolio, and that's moved up a little bit on price action mostly. Uranium is right in there as well at 15% of the portfolio, and gold and ag both making up 12 and 10% of the portfolio respectively. As far as individual names that we would have added in the last few months, we added a position in 3 gas names, EQT, Antero, AR, as well as Montage Resources, which since making that investment has subsequently been acquired by Southwest Energy. So that is now no longer in the portfolio, and instead we have Southwestern in there. From a performance perspective, it's been a very, very volatile year. As of 10/31, which is our last sort of published numbers that we put out, the fund was down 25% for the year. Again, when I said there's a silver lining, that's actually nearly 10 percentage points better than the IGE or the S&P North American Natural Resource Stock Index that many of you benchmark us against, which was down 34% for the year through October 31st. We bottomed on March the 18th amidst all the coronavirus related panics. And since then, we've had a very, very strong performance off that bottom. So from March 18th to the end of October, we find ourselves up 62%, which is handily beating the IGE or the S&P North American Natural Resource Stock Index, which is up 43% over that same period of time. So a very strong 19 percentage points of outperformance off the bottom. So granted that that's a pretty specific date we're using there, but just to show people sort of what we've been up to in this recovery phase of the market. That's mostly been driven by our gold and precious metal stocks, and our energy stocks have hurt performance there as well. So given the fact that we do find ourselves with 42% of the portfolio in energy today, and given our really, really bullish outlook there, I think there's potential for the portfolio to move dramatically higher as we go through the end of this year and into 2021. But that is sort of how things have shaken out through the end of October. I should point out that we don't, we publish numbers monthly, but anyone can look on Bloomberg or what have you. So from October 31st through November, the fund has done quite well, as has the broad market. But we have narrowed that year-to-date performance number quite substantially. So hopefully that'll continue through the end of the year.
I'm on mute. Great. Thank you, Adam. That was, sometimes there's things behind the numbers that people can't see. So thanks for giving us just the different perspectives from the bottom and through the recovery. Okay, so let's jump into the market outlook. And I'm really excited. I'm always so excited to listen to Adam and Lee take us through their views on the market. But I have to say, we called an audible in the quote green room when we were prepping here. And I'm going to pass the baton over to Lee to talk about something really interesting, which is investing in the uninvestable. So Lee, the floor is yours.
Okay, good afternoon, good morning, good midday to everyone. And like Adam said, I see that there are people signed up for this call throughout the whole world. In fact, I just saw somebody from Israel just signed up. So hello to all you people, and thanks for dialing in. Yes, we were going to talk a lot about energy today, and I would like to talk about energy within an interesting framework. And that framework is that energy today, we believe, has fallen into a category that asset classes very seldom ever see. And that category is that they have become completely accepted as uninvestable. And I'm going to give you a couple great examples over the last 50 years of asset classes that have become uninvestable and what has happened to them after they've been universally accepted as that. And what's so interesting about this is that these asset classes of being uninvestable don't occur very much. And the way that we define it's a class of assets that is an integral and fundamental and very strong part of the global economy and global financial markets. Second, there's something that changes fundamentally in that in the fundamental of that asset class that causes prices to go down. That prices continue to go down, and that it entered into a bear market. And eventually what happens is this goes on for so long that those fundamental trends that have caused the bear market are become universally accepted that it will never ever end. And at that point, the asset class at that point becomes what we believe is uninvestable. No one wants to invest in it, no matter what the price. Now, I'm going to give you two examples of this because it's like I said, we could only come across two examples over the last 50 years where that definition applies. And one is going to surprise you greatly because it's become by both these asset classes have become the most popular asset classes in today's world. And that is in the late 1970s, the stock market and the bond market both fell into the uninvestable class bucket. And why was that? Well, at the time, for those that have long memories, and I go back, my investment career started in 1981, so I missed it a little bit. But what happened is that starting in the mid 1960s, the U.S. and the world began to develop an inflationary problem, and the inflationary problem got worse and worse. And by the mid to late 1970s, it had become universally accepted by everyone that inflation would never be solved and that there would never be a solution to fix this problem. And of course, the markets that were most impacted by that were both the stock market and the bond market. The stock market, it topped out in the early 1960s, and by 1979, it hadn't done anything. And in inflation terms, it actually lost about 3 to 4% per year. And of course, the bond market for the previous 40 years only did one thing, and that was go down in price. It never went up. And so by 1979, everyone had believed that both stocks and bonds had become uninvestable. And of course, the event that signaled that to everyone was the very famous, infamous cover of Business Week magazine that came out in August of 1979. And the title was The Death of Equities: Why Inflation is Killing the Stock Market. And obviously, no one wanted, except for Warren Buffett, no one wanted to invest in those asset classes. And what happened? Something happened that no one ever thought. The inflation problem in the next couple of years was fixed. And ironically, the time that magazine came over in August of 1979, Paul Volcker assumed the head of the Federal Reserve the same month. And in the next 6 months, he jacked interest rates up 20%, broke the back of inflation, and inflation spent the next 40 years declining as a problem. So the thing is, the universal belief that made both those asset classes, stocks and bonds, uninvestable, turned out not to be true. And what happened? The stock market since then, believe it or not, the stock market in August of 1979 was 800. And it has gone up 35-fold in price. The bond market, which at the time, was still hadn't quite entered its bull market, but 30-year U.S. Treasuries went from 15.5%, and now are yielding 1.5%. It's been, again, it was the buying opportunity of a lifetime in both asset classes. And it's a great example of what happens when an invested asset class becomes uninvestable. Now, the next one I'm going to talk about is interesting because now all of a sudden it is becoming very popular. It's being recommended all over the place, and even I like it today and think it's going to go much higher. And what market am I talking about? I'm talking about the gold market. But one of the things about gold that people forget is that by the late 1970s, everyone had made accepted the fact that gold had become uninvestable. And why was that? Well, gold was basically demonetized in 1971 when Nixon took the U.S. off the Bretton Woods gold exchange standard. But even after that, gold was still perceived as an asset class that had a lot of uses. Protection against inflation, protection against volatility in financial markets and things like that. However, starting in the early 1990s, the European central banks, in reaction to the fact that gold prices had spent the last 12 years going down, and that bond prices now have become a popular asset class and spent the last 12 years going up in price, had decided to undertake a program of starting to sell their gold, which, remember, the European central banks had huge amounts of it left over from all those years of being on gold exchange standards. They decided to begin to sell that gold and take the proceeds and invest in the bond market. Well, the Europeans, as the decade 1990s went by, the Europeans picked up their selling activity to the point by the late 1990s that there was almost panic in the gold markets as all the European central banks began to try to front run each other in selling their gold. And the bottom of the gold market actually happened in 1992 when Britain announced it was going to sell half its gold, and then the complete killer announcement came when Switzerland which was the last world currency to still have a gold backing. They voted to undo the gold backing, to remove the gold backing, and they announced that they're going to sell half their gold reserves. Half of it was 1,500 tons, which is a massive amount of gold. At that point, everyone had become so bearish. Why? Because everyone was saying, all the banks, central banks of the world, since gold is no longer needed as a financial asset, it's all going to be sold, and that process is going to take somewhere between 30 to 50 years to undertake. So, and it just wasn't only the central banks that were selling. The European central banks, in an incredibly dumb maneuver, not only began to sell their gold, but began to undertake a policy of lending their gold out, and basically lending the gold out to their enemies. And who their enemies were the bullion banks and hedge funds that were borrowing their gold and selling it, front running them and selling it in front of them. Also, the whole gold, people become so bearish about gold that the European, all the gold producers of the world had given up that the gold price could ever rise again. And they had begun to actually, they were seduced by the big bullion banks, Goldman Sachs, UBS, into forward selling all their gold reserves or selling their forward production. And again, these were all set up by borrowing gold from the central banks and selling it, and then entering into derivative transactions to basically lock in the price. And so you had central banks, you had producers, and you had hedge funds and bullion banks, just in a torrent of gold selling. And everyone accepted that this was going to go on for years and years. And it produced one of the most oversold markets ever. Compared to financial assets, gold had never been cheaper. If you compare the price of 1 ounce of gold to the Dow Jones Industrial Average, in 1999, the Dow was priced 45 times the price of 1 ounce of gold, which easily eclipsed the previous record of 1970, which is 30 times, and 1929, which was 20 times. Both of those previous periods to be an excellent time to buy gold. So no one wanted gold. Well, what happened? Gold was so radically undervalued. Does anyone want to guess what the best performing asset class from that business? I'm sorry to talk about something from 1999 to today. It's not the stock market. It's not the bond market. It's the gold market. And these are great examples of what happens when an underlying an asset class is thrown into the uninvestable bucket. Now, what is the quintessential asset class that has been thrown in the uninvestable bucket today? It is oil. No one wants oil. Well, why is that? Well, we have the ESG movement, which tells us, if you're a large financial institution, you can't own oil. It's so bad. We have the whole push to renewable energies, and we're going to talk a little bit about that because we've done huge amounts of research on that. You have the idea that, given these factors, that investors now believe that the long-term investments that the oil industry has made in future oil production, that those assets are going to get stranded and will have to be written off to the tune of billions of dollars. And then you have people running around, and including a well-known investment shop here in the US, saying that the oil and gas industry is ultimately forced to be fined and pay penalties for all the environmental damage, that is the CO2 they put into the atmosphere over the last 30 years. They're going to have to pay damages of trillions of dollars. So based upon all that, it's no wonder that oil today has become the most radically undervalued asset class out there and is uninvestable. However, as we might talk about today, if we have time, is we'll tell you that each one of those points that we believe that everyone has assumed is going to happen is not going to happen. Just like everyone believed back in 1979 that inflation would never be fixed. I remember vividly, no one thought inflation would be fixed back then, but it was. In 1999, no one thought that gold ever had a future. And it's so funny. Read our last letter. I put some quotes in there from the very famous Financial Times cover story on gold. It was called "The Death of Gold," and gold when they did that was 800 and 800. I'm sorry, what was it? Anyway, $880 an ounce, and that, oh, I'm sorry, $280 an ounce. I'm sorry, and that gold it definitely had no future whatsoever. And of course, if you had invested in those two asset classes at the time, if you'd done careful research, and like I like to say to people, the gold thing is it's something that we experienced. And please, Stacy can send you all. I was profiled in Forbes magazine in May of 2000, and it's so funny. I didn't really want to talk about gold because it was so unpopular at the time, but the reporters were so fascinated with it that they eventually wrote most of the article about gold, and the headline is "Gold $2,500 an ounce?" ? And I said that gold was going to be one of the best performing asset classes of the decade, which it was. And so we've been there before in investing in uninvestable asset classes. Mark my words, oil today is been thrown in that uninvestable bucket. It is radically undervalued. It is now the smallest industry group in the S&P 500. And we believe that all those things that I just mentioned, those things that made oil uninvestable, not one of them is going to happen. Or if they even partially happen, then that's okay, because the valuation of energy securities is so low. You have so much margin of safety in them because they're so depressed that oil is going to be a phenomenal investment, even if some of those things do happen, which I just mentioned. So with that, I'm going to turn it back. But the funny thing about investing in uninvestable classes, let me tell you, it is very, very difficult to do. Very few people have I would say, the internal fortitude to do it. But if you do, fortunes are made.
Wow. I mean, contrarian value all the way. And as you were talking, Lee, you probably couldn't see it, but there were a couple people commenting like, not everybody, so we have some kindred spirits in our midst for sure. You mentioned something, which was that whole ESG concept as one of the factors that's making oil uninvestable. And you also alluded to the research you've done there. We hear this all the time, right? Electric cars, it's the future. All of this is the future. Adam, how do you respond to that?
Well, we have a couple different things to say about that, and this will be a good opportunity to talk about some of the research that we're doing now that we hope to have available for everyone over the next, I would say, 3 to 4 months. But on one level, obviously, where people are really worried about oil today, the narrative that sort of surrounds it has to do, as Lee mentioned, and as you mentioned, Stacy, with ESG. The idea, is oil effectively, the new buggy whip? Is it something that's going away, and its sort of future is finite, and as a result of that, the terminal value of these companies is effectively greatly impaired. And so one thing that I would say, before we get into the whys and the hows and all this sort of thing, is to a large extent, I would say to people that are really concerned about that's largely priced in, I would say. I know that might sound like a very bold comment and a bold statement to make, but Lee and I, right before this call, we were going through some of the different numbers. And on the one hand, you have the oil and gas companies, and on the other hand, you have the green technology companies, whether it be solar, wind, or probably the one that is really capturing people's imagination right now, which is hydrogen. And we can talk, all about hydrogen because it's a really fascinating concept. It has a lot of drawbacks, some potential, but some really, really difficult challenges ahead. But when you look at some of these companies and the amount of money that's chased out of the oil industry and towards some of these greener technologies, I would argue that if we don't have a full immediate transition to electric vehicles, oil's a buy. You know, it's already been priced in, is what I'm trying to say. And so if you think of a company like on the hydrogen side, you know, Plug Power is probably the most well known, and I just pulled it up on the Bloomberg here. And as of today, it's now trading at 15 times its book value, 24 times sales. And so if you backed into what the implied growth rate would have to be to justify a company trading at 15 times book and 24 times sales, it's obviously incredible and immense. On the flip side, you take some of the less loved oil E&P companies, and if you take a low oil price and you just simply look at the amount of proved reserves that they have, undiscounted over the next 10 years, you can pay for their enterprise values today. So I would argue that the terminal values on a lot of these companies have already been written off. And to the extent that we still have internal combustion engines after 10 years, which, by the way, you know, I can guarantee you we will, that the oil stocks represent a strong buy here. And so that's the first thing is, you know, for people that I think are worried about it, I think first and foremost, you need to diversify and hedge the risk that perhaps we will have a future with oil, because right now the chips are all on the side that we won't. The second thing is all of the challenges that these different green technologies face, and they're really, really dramatic. And so we can, you know, either on this call, we can go over a few of them in brief. And I don't know if Lee, you know, feel free to cut in if you ever have anything you want to add, because I know that, you know, we've talked about this at length and for hours and hours and hours. But if you look at both the issues of cost of the various renewable sources, so that's one thing. Now the costs are coming down, and there's debate as to why that is. But costs remain a serious challenge. But even more than that, when you look at solar and wind, you have huge problems of intermittency. So you have this idea that the sun doesn't always shine and the wind doesn't always blow. So how do you keep to smooth that out and provide a level dispatch of power remains a really big unanswered question. I know it sounds sort of crazy that that could still be a question, given people assume that renewables will take over, but it still is an unsolved question. Batteries at the grid level basis don't work as of yet. Furthermore, if you were ever to really work out that math, the amount of raw materials on the battery side of things would begin to become prohibitive very, very, very quickly. Hydrogen, it's really just the cost of making hydrogen becomes nearly prohibitive today to make green hydrogen, which is hydrogen that doesn't emit CO2. And so that remains very challenged on that side as well. We've done a huge amount of work on the batteries, and we just see challenge after challenge there too. Of course, there is some positive developments and some positive things to note. And one of those is that the power that nuclear energy can really play in helping to decarbonize the world. And that remains a huge source of potential benefit from a low carbon future. But that's not really something that gets written about too much. And that's not that doesn't seem to be the road that we're going down. So when you put it all together, we've decided that we would like to do a really comprehensive review of a lot of these green sources, of a lot of the sort of future of energy, of a lot of the assumptions underlying different organizations like the International Energy Agency or the BP Statistical Review. Everyone's put forward these studies, and in these studies, they're now being quoted by, you know, thousands and thousands of investment professionals, but very few people actually know what goes into these studies. And so we'd like to try to dig in deeper and present that in a way that's comprehensive, hopefully authoritative, and shed some light on the right way forward and some of the mistakes we're making. Because right now we're going down the wrong path. And the path that we're going down, it will not solve our global CO2 problem, and it's going to be a malinvestment on the order of magnitude of trillions of dollars. And as that money gets diverted away from oil and gas, it's setting us up for this huge supply shock that won't be able to be met by electric vehicles or renewable energy. And that leaves us, I think, very, very vulnerable and also very bullish on the future of oil.
I just like to add,
Yeah.
you know, obviously, Adam and I have spent a lot of time studying the renewable industry. We've written a lot about it. And like Adam says, we'll put out a big paper and probably do a podcast regarding all the research that we've done on renewables. But it's interesting. Adam brought up an interesting point, which I hope that all of you keep in the back of your mind, is that we're going down the wrong path. And the thing is, we're going to spend trillions of dollars of money on green energy investments, of which they may not and will not solve the CO2 problem. I'm going to give you a great example of this. Everyone's raving about hydrogen today, and I should tell I come from an oil family. My parents used to work for Exxon. My father's a chemical engineer, and he used to always tell my brother and me, this is like 25 years ago, fuel cells will never work. And he said, I said, "What's that, Dad?" And he said, "Well, do you have any idea how much energy is required to make hydrogen?" One of the things we forget is hydrogen doesn't occur naturally in nature. It has to be manufactured. You have to break those carbon bonds, and you have to do it with energy. Now, okay, everyone says, okay, we're going to do it with green energy. We're going to build these massive windmills, and when we don't need the energy from the windmill, we'll make the green energy. Or we make the electricity that will break these bonds. But think about it this way, one of the most intensive inputs to windmills is cement. You have to build these massive cement foundations on which they sit. Some of the studies indicate this, if we were to develop a full windmill-driven economy, that's basically going to double the amount of cement that's needed in the world in the next 30 years. Well, does anyone have any idea what percentage of CO2 is put in the atmosphere today from cement manufacturing? It's 8%. 8%. And you're talking about going from 8% to 16%? Is that going to solve? Is that going to help hydrogen solve the issue? Besides all the costs that are associated with that, it's something that people aren't thinking very much about. And so, anyway, we're not against green energy. We believe there's a future, but there are going to be costs. There's going to be disappointments that are going to be associated with it going forward.
Well said, Lee. Thank you for that. And Lee, there's a little bit of feedback on your line, but we'll monitor it. I'm able to hear you're okay, but just so everybody knows, we're aware of it. Thank you. So let's switch gears a little bit. You alluded to this, Lee. You mentioned the exposure in the S&P 500 of energy, and you guys did put out a great chart, a shocking chart actually on that a couple of weeks ago. So don't investors, there's this belief amongst investors that they already have sufficient exposure to energy, to natural resources through their existing US equity exposure. Can you speak to that?
Yeah, it's interesting because, going back to 1980, you could say, well, the S&P gave you tremendous exposure to inflation protection and commodities and things like that. Well, one of the most important reasons why is that 30% of the S&P back in 1980 was energy related, and 6 of the 10 largest market cap companies in the world were energy stocks. Today, the S&P weighting of energy, I believe, is flirting today with 2%. It's the smallest energy group. When you own the S&P 500, you have no exposure to commodities. You have no exposure to inflation. You have a huge exposure to expensive tech stocks. So investing in the S&P, you get some sort of inflation protection, exposure to what we believe is going to be the tremendous performing energy space in the next coming 5 years, 7 years. You're not going to do it by investing in the S&P.
Great. Adam, do you want to add anything to that one? If not, I'm going to move on to next. We have so many questions, so totally fine. We can move to the next.
I think that covers it. And the only thing I was going to say is that we actually on the 6th of November actually crossed the 2%. I'm sorry, hit a low of 1.8% weighting of energy in the S&P 500. So no, I think it's just you don't have it. I think that that actually makes for a very bullish tailwind, because you have all these active managers out there and they're thinking about ways to look different than their competitors or look different than the index. And I think if you start to see a little bit of outperformance in energy, people will say, oh my goodness, I don't have to add much to be very, very off benchmark here. I don't have to take the portfolio to a radically different composition, even adding 5 percentage points above the benchmark weighting could potentially. So I think that, the downside to energy now is that it's at risk of becoming a little irrelevant. You don't have the same, financial reporting media attention and things of that nature on the bullish side anyway, because no one has any exposure. No one really cares. People are closing their energy desks left, right, and center. But that could work in reverse as well, because no one has any exposure. And so money's going to come to chase, relatively small market caps, and that'll have a big impact. We saw that, on the announcement of the Pfizer vaccine a couple of weeks ago. Energy had a sharp move, and I think that was probably a lot of short covering, but at the same time, it just goes to show that, capital flows make a huge impact here on the energy space because it's so small.
Well said. Okay, we have been getting a lot of questions today and pre-submitted about inflation. So I'll just kind of throw that out as a general topic, and then more specifically, how have natural resources stocks historically performed in periods of inflation?
Well, I mean, put simply, natural resources stocks have been what have protected you during inflationary periods, and most notably would have been during the 1970 experience with inflation. But clearly, given the fact that they are both raw material price sensitive, so they're price takers, but as inflation drives raw material prices higher, commodity companies tend to benefit from their operating leverage. Their earnings go up a lot more. The other thing that really helps them is that they're very asset heavy companies. And so they have a huge amount of invested capital in their asset base, whether it's their mines or in their oil fields. And in an inflationary period, asset heavy things tend to outperform asset light investments because the cost to replace the assets go up. And so your, relative to your book value or what have you, those assets keep pace. So that was definitely the experience through the 1970s. That was the experience historically as well during moments of inflation. And I think that will be no different this time. Lee, do you have anything you want to add to that?
No, it's going to be the place to be if inflation comes back, and we do think inflation is going to come back. So, yeah, natural resource stocks are they've historically been a great place to be. Even at times, they radically outperform just about everything during those periods of inflation.
Okay, great. Thank you for that. All right, so let's see. So let's move. There's so many great questions coming in, guys. I see them. This is awesome. Keep them coming. We have a question about gold to oil ratio. How are you feeling about that ratio? Oil needs to go up, gold needs to go down. Can you speak to that?
Yeah, this is Lee. I can definitely answer that question. If this is something that's always intrigued us. Is one of the things about looking at the ratio and how gold is priced relative to the price of oil is that I've always believed that gold is the most important financial commodity in the world. It still is to this day, and that oil is the most important industrial commodity in the world to this day. And what's so interesting about those two commodities and their prices is that they have an interesting historical relationship that goes all the way back to the late 1850s, when oil was discovered and oil actually began its introduction into the global economy. And that is that oil is very, very cheap and gold is expensive relative to oil. An ounce of gold will buy 30 barrels of oil. And that when gold is very, very cheap and oil is expensive relative to gold, that an ounce of gold will only buy 10 barrels of oil or less. And if you're curious, we put these charts in our letters multiple times, all the way back to 1850. It's interesting. You can see that very, very seldom has gold, when oil is expensive and gold is cheap, that is the ratios at the bottom, does it stay there? And conversely, when gold is very, very expensive and oil is cheap relative, and the ratio is 30 or above, it very, very seldom stays there. And what's so interesting is in the last 4 years, we've made 2 all-time record highs in the gold oil ratio, saying that gold as a commodity relative to oil has never been priced more expensive. One was back in January and February of 2016, when the ratio hit 46 to 47, which is the highest ratio that we keep in 150 years of records, the previous record being 39 back in 1934 in the midst of the Great Depression. And again, during the pandemic, COVID pandemic epidemic in March and April, the ratio went to infinity as the price went negative. Using the Brent price, which fell to 20, the ratio hit 80, which is, again, these are, in all the data that we keep, the monthly data we keep, these are 6 sigma events. There's something that we should only experience once every multiple thousands of years. And so with oil being incredibly cheap relative to gold, we think we're in a position where oil is going to outperform gold probably for the next several years. And there's some underlying fundamental things we've written about a lot in the last couple of letters. That the supply of oil grows faster than the supply of gold. That ratio will rise. And when the supply of gold grows faster than the supply of oil, that ratio will fall. And so we're a firm believer that we're going to see the supply of oil rise much less faster, slower than the supply of gold. And we believe we're all set up for the gold oil ratio to go. Today, I think it's 45 or 43. It's going to shrink significantly in the next couple of years. And that fits in with our overall belief that oil is this radically undervalued asset class. And it's where you should put, if you're an enterprise investor, you put more money in today into oil than gold.
Thank you, Lee. You're breaking up there a little bit, so I don't know what it's almost, but Adam's very clear, and I know you guys are on the same network, so just a thought.
Okay.
Adam, I'm going to pass this one to you. There's a bunch of questions about oil supply, from just an update, expectations, people asking about what kind of data is behind this neural network. Do you want to take that one?
Sure. And before I start here, I'll just move out of the way. So Lee is behind me. We're trying to be socially distant and be 6 feet apart from each other. So instead of huddling around one PC, we are in the same room. So if worse comes to worse, I'll switch headsets with him or something like that. I think there's a news anchors once that pretended to be in different cities and different studios. It turns out that they were in the basement of the same house together. But anyway, it's the same kind of thing. So the question, I'm sorry, was one more time.
Yeah. So just basically, there's a lot of questions on oil supply.
Yeah.
General update on the research you've done there, kind of a forward look.
Yeah.
Also questions about your neural network, and if you can speak to some of the data that underlies your research.
Sure. So if you look at oil supply in the United States, it's been a very, very complicated year, and we've been trying to walk people through this since our original call back in March, when the coronavirus really started to come to the fore for the first time. And here's basically what's been happening in the United States. The story in the rest of the world is similar, but a little bit different. But in the U.S., here's what's been happening. Inventories moved higher and higher and higher as the country was locked down. Really, the world was locked down back in March and April. And there was a fear that inventories were going to breach their maximum limits. And in response to that, a lot of oil producers shut in their wells proactively. Now, it turns out that inventories were never really quite as high as we had feared them to be, but there was this big, wide-held belief that they were going to reach full inventory, in which case everything would back up through the system. In response to that, everyone shut their wells off. The other thing that they did is that they stopped drilling new wells. And so if you look at the rig counts in lots of different shale basins in the United States, it wasn't uncommon to see the rig count fall by 80 to 90%. In some cases where you were drilling 30 or 40 rigs, you went down to 2 or 1, some went down to 0 rigs. So you had these two things that were both going to affect supply: shutting in of existing wells where the wells are already flowing, and then you stop drilling any new wells. That took production off quite dramatically in April, May, and June. And then through the end of the summer, what started to happen was the oil price stabilized, and some of those wells that were taken off were starting to come back on. And that became very difficult, I think, for a lot of people to analyze, because now you had two things that were going in opposite directions instead of two things that were reinforcing one another. So you had wells that had been shut in that were now coming back online, adding to a surge in one-time production as you brought those back on. But you still had this underlying problem of not drilling enough wells to keep up with the underlying field level depletion. And so if you brought on a lot of those shut-in wells very quickly, you could actually get production to grow for a month or two or even 3, depending on how many you did and when you brought them back online. And I think that that's what we saw for August, July, August, and September. And that, I think, worried people a little bit. And I think there's a little bit of confusion. Some people, we saw even printed articles saying, look, supply is growing materially, even though we don't have any rigs operating. That goes to show you how great we've gotten at drilling oil. And we said, listen, guys, this is a really, frankly, probably one of the most confusing supply stories we've seen, because you can't parse the data as naturally or as tidy as normally you can. Now, we're a little bit different because we look at wells on a well by well basis. And so we have this very, very big data set. And then more importantly than that, we also have a lot of analytics and a lot of tools that we've developed internally to help look at that. So what were we able to do? We were able to do a couple things. And I should point out that the raw data comes from a very, very good firm that we like to work with called shaleprofile.com. They have a blog. They have some interesting insights there. I highly recommend them. But their data has been really good and helped us to unlock some of the insights once we run it through our analytics. So the first thing that we did is we said, okay, looking at a well by well database, how can we determine what wells were shut in and what wells weren't shut in? And the way that we decided ultimately to do that was by projecting what should a well normally have produced if it was not shut in, and then compared that to what the well actually did do. And if you see this pattern that emerges over and over again, where there's some natural noise and variability in the data, but then come March and April, about 30% of wells, in some cases, just all of a sudden deviated dramatically from the model. That test represents a shut-in well. So we were then able to flag those shut-in wells. We were able to leave them aside and say, what does the not shut-in well population look like? What has that done over the last couple months? And then it also even allows us to say, okay, now we can project when the shut-in wells are coming back, and if they come back in July and some in September and some in October, what does that do? And does that start to look a little bit more like reality? And the answer is yes. And so we became very confident that we were now having a pretty good handle on what was going on. And what was going on? Well, like we said, you had this rush of shut-in wells coming back online, offsetting the very, very low level of activity. And so that has largely played out now. So beginning in October, which I think when we wrote the last third quarter letter, we had one data point that confirmed it. Now I think we have a second one, and some more anecdotal evidence lining up as well. That does seem to be what happened. November showed, or October rather, showed sequential declines month on month. September showed sequential declines month on month. Most people agree, and our data confirms, that by the end of October and middle part of November, you've basically brought back all the shut-in wells now. So everything's back online and producing. And look at it year on year. Year on year, we're down dramatically, over 1 million barrels a day of production. And so that's not a question of shut-ins. That's not a question. That's not stuff that can now be fixed other than with more drilling. And you're not going to have more drilling until you have higher oil prices and the right signals and incentives for these guys to produce. And you simply don't have that today. So there's been a lot of noise this year, a lot of confusion. The initial slowdown in production was really, really dramatic. Then you had this kind of rebound, and now it looks like it's rolling back over again. So we'll continue to monitor it very, very closely. There's very, very little way that I can see for a sustained production increase from here. You just aren't turning enough rigs. And again, to keep this in perspective for people, last October, last November, last December, you started to see month-on-month declines in the shales. And that was with a rig count that was in some cases 8 times higher than where we have it today. So when I read these articles that say, well, maybe production is going to stabilize in a month or so and stay flat at these levels, it wasn't flat when you were turning 8 times as many rigs. I'm not really sure how it can be flat today. So we'll have to wait and see. There's been a lot of noise. That's always the way it is. In all the time that I've been doing this, I'm constantly waiting to see what the next data release is going to be. It's never solved the issue or put the mystery to bed, but you're always constantly waiting for that next piece of data. And so I think we're going to see more supply disappointments in the U.S. In the rest of the world, supply is coming off quite sharply. So that trend continues to be in place in the rest of the non-OPEC world. And rig counts there are down 50, 60+% as well.
And I'll just add, it's that just look at some simple numbers to show you how impactful this drilling activity or retrenchment drilling activity is. back in the beginning part of the year, there were 50 rigs drilling for oil in the Basin. Today, you have 13 rigs. You are, for all practical purposes, you're in what they call PDP blowdown mode. There's very little drilling taking place, and you're just running off the reserves that you have there. And remember, the Bakken, was considered one of the great sources of oil growth at the beginning part of the shale oil revolution. It peaked out at 1.3, 1.4 million barrels a day. The DJ Basin, which is another oil shale basin, which has had tremendous growth in the last 5 to 6 years, is that they had 30 rigs operating at the beginning part of the year. They have 3 rigs drilling in the entire DJ Basin today, and even in the Permian had 425 rigs operating at the beginning part of this year, and you're down to just a little over 150 today. So at these levels, we are not going to see any oil growth from the shales, and the way we're modeling, unless we get some sort of rapid pickup in the rig count in the next several months, we're gonna lose another 1 million barrels a day of oil production from the U.S. shales. And please remember, people, that 90% of all the oil supply growth in the world the last decade came from the U.S. shales. Everyone else is already rolled over. It's the only source of growth, and that growth is now in the process of disappearing.
That's great. And your mic's sounding a little bit better, Lee, so that's good.
Okay.
There have been a bunch of questions throughout your comments about, okay, so if we kind of agree with all of this, how do we play these ideas, right? How do we invest in this? Can you speak to, some people are using ETFs. I think, Adam, you talked a lot about how flows are sort of impacting things. If you're an investor sitting here, how would you advise them to think about ETFs versus a strategy like you guys, which is actively managed?
Right. And thank you for that, Stacey. And before I answer that, I just wanted to bring up something that I saw in the chats here and some of the questions that are coming in about oil inventories and just the basic state of the oil market, because we're talking about supply.
Sure.
And obviously we're very close to this and we're tracking it day by day, and demand, people hear all kinds of mixed things. Demand actually came back a lot stronger than people expected, but now there's second rounds of lockdowns and things of that nature, particularly in Europe, and probably potentially more coming here. And so where do the oil market balances stand right now? Well, we're in a very strong deficit. Inventories peaked at the end of June, basically when we said they would. And since then, inventories are drawing at the fastest rate on record. So remember that inventories sort of are the intersection between supply and demand. We keep stockpiles in the United States and in other parts of the OECD world, and some in China as well. And by looking at whether inventories are going up or down, we have a fairly real-time gauge as to whether or not demand is running ahead of supply, in which case inventories shrink, or supply is running ahead of demand. And so inventories right now are drawing at the fastest rate on record. It's faster than it was in 2017 and 2018, which is ultimately what helped to bid up prices there. And we expect that to continue, barring some major change in demand. So things are progressing well. Supply is falling, demand has somewhat stagnated, but has come up dramatically off the lows. And we expect, particularly as the vaccine begins to take hold in the early part of next year, that we'll start to see things begin to normalize very, very quickly. We're in a deficit, and we have been in a deficit since the end of June. And I think, believe it or not, the excess inventories that we accumulated during coronavirus will probably be worked off by the end of March. I think, probably could be even sooner than that. The trends that we're seeing are similar in the US and in the rest of the world. So that's good confirmation as well. Because for those of you who are less familiar, we get the data more real time in the US, and then about a month later, we have it confirmed with the rest of the world. And so we're seeing those numbers confirmed. So I think that we're in fairly good shape from a fundamental perspective. Now, as far as the ETFs go and questions and flows into the ETFs and things like that, it's a really good question. It's something that Lee and I talk about, as this sector rotation begins to shift, will money be attracted back into the ETFs versus into actively managed funds and things of that nature. But I think for investors, the most important thing is just really, how selective you want to be, and particularly in the energy side of things. I don't know that there's going to be blanket winners across the board. Rising oil price should probably help most energy companies and probably all energy companies. But I think a big part of this new bull market is going to revolve around the fact that the shale inventories are now mostly developed, particularly the good ones. And so the good quality companies that have good remaining inventories are sort of few and far between. We estimate probably no more than 15% of the universe really screens really, really well from the quality of the remaining assets. So it's really a question of have and have nots in a lot of these. And so we obviously see a lot of benefit in trying to be selective there. Lee, I don't know if there's anything you want to add to that.
Yeah, and we will definitely have a lot of exposures where the ETFs won't have the exposures. I mean, I know there's a lot of questions coming across the screen here about nuclear power and how that fits in. We could talk about that for hours. But for example, we have significant exposure to the nuclear power, the uranium business today. Again, we're very, very bullish on agriculture, and we are we believe that we're going to have a massive bull market in the agricultural space. Some of the ETFs don't have any agricultural exposure, and we go when you invest with us, you go throughout all the areas of the natural resource markets and shift back and forth where we believe that the best returns are going to be. And you don't get that in a passively managed ETF.
That's helpful, Lee. In fact, there's a lot of questions about market cap as well. Any comments on that vis-a-vis the ETF strategies versus what you're doing?
Yeah, I mean, for example, the ETFs, especially like the XLE and the IGE and the GNR, I'm sorry, they have, they're primarily Exxon Mobil, Royal Dutch, Total, BP. So they're mega cap, and we're much more mid cap, slightly smaller cap. And of course, that's hurt us the last 3 or 4 years because small cap has definitely underperformed large cap. And so the thing is that, however, if we're at the bottom of the cycle and we're going to have this huge rotation, which we believe would started already, is that mid cap, small cap will outperform large cap, and so that's another huge advantage that you will get with being with us.
I'm watching the clock. I want to be respectful of everyone's time. There's been a lot of topics in the questions today and in the pre-submitted about natural gas, which we haven't talked too much about. Do you want to give a little bit of an update there?
Yeah, sure. The natural gas bear market has been one of the most severe bear markets that that an investor could ever have been put through. Gas prices peaked, I think, at the end of 2008, and from peak to trough declined over 90%. And it was all because of the Shale Gas Revolution, which started back in the early 2000s with the quote unquote discovery of the Barnett Field in East Texas. And during that time period, natural gas from 2003, 4 to today, natural gas supplies almost doubled. I mean, that's incredible. And it's all because of shale gas. And what's interesting is the biggest drivers of shale gas supply in the last 10 years has come from, there's actually been 3 sources. They've come from the Marcellus, they've come from the Haynesville, and they've come from the associated gas produced out of the Permian. And those 3 fields over the last decade have probably are responsible for almost 100% of the growth in gas supply. Now, what's interesting is that all those 3 fields, Marcellus, Haynesville, and the Permian, is that especially the Haynesville, then the Marcellus, and then the Permian, is that those fields' gas production, after growing immensely in the last 10 years, are all plateauing right now and are about to roll over. And we have this wrong idea about all these shale plays that somehow that the more money we throw at them, and that the supply and the growth of supply from these shale plays is unlimited. Nothing could be further than the truth. And we have 2 examples of that already. And they're the first gas shale fields that were discovered and brought online. That is the Barnett in the early 2000s and the Fayetteville in 2005, 2006. And both those fields today had huge ramp ups. Barnett went from 0 to almost 5 BCF of gas today, plateaued, and today sits about a little over 2. The Fayetteville started at 0, ramped up to almost 2 BCF a day, and today stands at I believe, at a little under 1. So both fields have declined now from peak to where they're today by 60%. And it's the underlying geological forces that are working these plays that have caused this to happen. Those geological forces, which we understand, Adam talked about our neural network. We sick our neural network on trying to tell us what are the forces that make fields plateau and then ultimately decline. What are the traits that we should look for? Come back and tell us what those traits are. The Marcellus and the Haynesville are both experiencing those traits, and so huge amounts of the source and gas supply is now dissipated, and both those fields are plateauing, and both will begin to decline. Haynesville's started to decline already. The Marcellus should be declining in the next couple of years, and gas demand is incredibly strong today. So the thing is that gas supply is going to have to ultimately be rationed by much, much higher prices. So we believe the bear market in gas is over. We believe that gas prices are going to go into a bull market, and we believe that natural gas investments are going to be superlative investments in the next couple of years.
Thank you, Lee. That was great. And I have my eye on the time. It's 4 o'clock. There is so much more to talk about. I realize that. And you guys have asked some amazing questions. I think the takeaway for me is we need to do more of these calls with Lee and Adam. So stay tuned. We'll work on that. Thank you, everyone, for your participation. And Lee and Adam, thank you so much for taking the time. Your insights are always, always amazing, and especially in markets that are as challenging as we're in right now. So again, for everybody who asked questions, we have them all. We will corral all the information and get back to you as soon as we can. We'll get this call transcribed and the replay out to you. And as I said, stay tuned. We'll do more of these so we can cover all of the amazing topics that you guys are teeing up. Adam, Lee, any closing remarks?
No, thank you everyone for listening in. It's the most depressed area of the financial markets. It's as depressed as stocks and bonds were back in the late 70s. It's as depressed as the gold market was back in 1999, 2000. And for those that are willing to make the difficult choices here, you're by 2000, 2005, 2006, 2007, you're going to have phenomenal returns.
27.
27. I'm sorry. Got all the decades are running into each other.
Thank you guys so much.
Okay, very
Thank
good.
you.
Okay, bye-bye.